Where is the custody conversation going to be in 2023? We're joined today for Blockchain Week Day 2 with Scott Waller, Associate Partner at EY, and Michael Shaulov, CEO and founder of Fireblocks. Take the stage, please, gentlemen.
Thank you, Amy Rose. Hello, everyone. A pleasure to be with you for Day 2 of Australian Blockchain Week, and here to talk around crypto custody, which I think Michael and I were just talking prior to this start of the session. Really no bigger topic, I would say, at Blockchain Week this week, with the announcement from the government yesterday around an inquiry into legislation and regulation around custody. So we'll get into that as part of the conversation today. So firstly, Michael, welcome. Great to have you here as part of Australian Blockchain Week.
Thanks, Scott, for having me. Thanks, everyone.
So I feel like in order to talk about 2023 and you know, still being in March in 2022, that feels quite futuristic in the world of blockchain. We should probably level set for people around current state and where we've come from before we discuss where the industry is going. So, but perhaps let's start the conversation, Michael, around take us on a bit of a journey from what you've seen in the custody market over the last 4 or 5 years as you've started Fireblocks. How is custody different today from where it was at in 2017 and 2018 in terms of what customers are demanding?
Yeah, Scott, I think it's an excellent question. We started the company in 2018 and started conceptualizing it back in 2017. So definitely, there is a huge difference between where the space was back then. You know, back in 2017, most of the custody market was really focused around, say, like this kind of pure cold storage use case where the only thing that folks were interested in was essentially in keeping Bitcoin for, you know, very long-term investment use case, and therefore, you know, the state was that people would have bunkers in the Swiss Alps where they will sort of shard the private key, and in order for you to do a withdrawal, you will need to do multiple Skype video conference calls, and people will physically run into those vaults, sign the transaction, and will send the transaction. And clearly, this was a very unscalable process, which was great, you know, when you wanted to buy Bitcoin and keep it in the vault for a few years. That, you know, I think for the folks that did it back in 2017, assuming that they didn't sell it, yeah, that was a pretty good outcome. But that was, I would say, back in the days, a few years ago, sort of the state of the art. The other option for people when they actually had to do something that was more active is that people were keeping their assets on the exchanges. And because the exchanges really didn't have any scalable hot storage, and they had to keep some of those assets online, that was a catastrophe, right? If people remember what was going on back in those days, there was hack after hack. There were hacks multiple times a week, and there was a lot of money, a lot of crypto was lost, and that was basically the state of the art back then. Clearly, things have moved significantly since that period. You know, nowadays I think there are a lot of different solutions in the market that represent sort of best of breed technologies around how to keep assets secure and accessible. Okay, Fireblocks is one of them. There was, I would say, a large migration into new technology called multi-party computation, or MPC, that allows us to do and secure that. So generally speaking, nowadays I think we are at a point where custody or security of the wallet infrastructure is at a place that it's both secure, but it also allows people this on-chain interaction with the underlying asset and with the blockchain, and really starting leveraging the real use case that this technology is bringing to the market.
Great. And Michael, in terms of your with Fireblocks and this demand or the shift in client needs to, as you put it, move from this cold storage based approach and kind of cloak and dagger with bits of paper and very, very secure, but also very inaccessible. Did this shift really start with crypto native businesses and their forays into putting their crypto to work, or has this been driven more from the institutional side coming to the table and wanting different operational processes and management around their crypto?
It started, I would say, with institutional crypto natives, right? So basically, not the banks and the asset managers that I think were joining the party or joining the transformation in the last 18 months. But keep in mind that when we started the company back in 2018, it was actually not a good point in the cycle of the market, right? It was everything was crushing, and Bitcoin was going to 3,500. And the big adoption basically started from institutional players such as Genesis and Galaxy, if people are familiar with that. There were fairly big brokers, fairly big crypto native asset managers that had to figure out how to survive a fairly difficult market, right? And when you need to survive that market, you have to be active, you have to provide, I would say, differentiative, what was at the time, right? Differentiative services, right? So those people and our, I would say, initial client base, they were really focused on active use cases around trading, around providing services around trading, lending, and things that required assets in movement, right? And they had to do it in a very secure and institutional way because they were treating clients' funds. They were treating pretty substantial client funds, and then what I would say, like the early adopters of the technology that in some ways had no choice but really to figure out something that gives them both the speed, the usability, and the security. Now, as the market recovered, and then basically as the real institutional adoption began, where we started to see more traditional financial institutions, whether it's hedge funds, whether those are traditional banks, fintechs, and so on, they were in an excellent position to basically leverage this technology. And nowadays, I would say the use case is really adopted across the board because the services around, hey, let's just custody crypto for someone, and that's it. It became somewhat commoditized, right? And also, I think that the market shifted significantly from that use case to for anyone across the board to participate in the market, right? So whether you're looking into DeFi, you're looking into staking, you're looking into prime brokerage, those use cases really require a fairly different underlying tech.
Yeah, absolutely. And just on that difference in underlying technology, I mean, you mentioned there's some of those services with DeFi and staking. When you approach customers to look at setting up a custody solution for crypto assets, a sense in the market is that this is still something that particularly traditional financial institutions getting into this space struggle with in terms of the risk context and the risk landscape. Could you perhaps just share your views around what do those people, particularly in the traditional finance space, who approach this well and do this well, what are the things that they do that are different perhaps from others who really struggle with the shift to the asset type and the custody model around digital assets?
Yeah, so what you realize is that once you start to, and also I think we always try to categorize traditional financial institutions. We're trying to put them into one bucket, right? But there are also quite a few nuances over there. Asset managers, they think about this problem in one way. Hedge funds, traditional hedge funds, thinking about this problem in a different way. And clearly, banks, even within the banking community, I would say that there are slightly different approaches that happy to sort of deep dive into each one of them. But in general, I think that there are two things that are trying to digest, right? One is, and both of them are related to risk, right? The risk around those assets in some aspects is similar, in some aspects very different from the risk that they have around custody with traditional assets. The area where I think that there is a lot of misconception, right, is actually around KYC AML, right, where people are highly focused on for good reason. And I think in the last month and a half, as we've seen the pile of sanctions on the international sanctions on Russia, clearly it just emphasizes how the world became complex in that regard. So that's like a first area where people are focusing on, and they think that it's very different, but actually the KYC AML issues in this space are fairly. They're fairly good solutions, and they're actually fairly similar to how you would operate in the traditional space. At the end of the day, you need to know your customer. They're also very good automated solutions for transaction monitoring, such as chain analysis, analytic, and some of those folks that can be. We made the integration into this flow like fully automated and simple. And last but not least, there are variations of the travel rule, but I think that all those things become pretty much out of the box. The second issue, which is very different from what they used to, is actually the operational risk, right? So on the operational risk, you're now dealing with an asset that, first of all, settles instantaneously, and second of all, when it settles, it has no recourse. And the third thing is that you can accidentally sell it to the wrong address, and it's gone, right? Which none of those attributes actually exist. Mostly don't exist with traditional assets. So people are trying to wrap their head around what does it mean, right? And what we've seen is that, interestingly enough, regardless if you're taking the cold storage approach or you take the hot storage approach, those nuances are really important to understand where they're being set up. There's less, for example, in cold storage, there is less interest in the traditional space in all those cold storage disconnected system facilities, right? Traditional banks, most of their systems are connected to the internet, right? So, for example, how to set up those rooms, how to make sure that your operators are fairly segregated, what are the policies and procedures, all those things are fairly new to the banks. And we have a team, we have a customer success team that helps. We're working actually on an international level fairly closely with EY to put all the procedures and policies in place. So there is already a knowledge that needs to be brought in and integrated into the risk departments of those institutions. And clearly, as we move into the sort of the movement of the asset over there, also there is a lot of education around the risk of how to make sure that you're interacting with the right counterparty, how to make sure that you're sending the asset into the right address. All those operational risks are somewhat new, and I think the good thing is that there are already pretty good solutions that the client needs to just understand and integrate.
Yeah, fantastic. I feel like with those risk areas you mentioned there, there are some scary elements to it, but the message seems to be that others have navigated it, and there are best of breed suppliers and tools and products that really help reduce those risks, along with a traditional risk and controls approach. This being Australian Blockchain Week, I want to perhaps focus on Australia selfishly a little bit here, and get your perspective on the Australian market, the Australian context, and in particular where you see the Australian market sitting in, say, the broader APAC market. How do we compare to our peers? Where are we at in terms of our maturity of adoption? How do you view the Australian market and the opportunity and the potential, given the political climate, given the state of regulation, to really seize the opportunity around this asset class?
Yeah, so I think that for us, we've been we've been active in APAC since, I want to say, March 2020. Actually, when it was great timing because COVID just hit. So that's actually was the month where we entered the APAC market, and I think specifically with Australia, I want to say that we've been active in the Australia market somewhat earlier, probably since January or so in 2020. I think our first client in Australia were a company called Zero Cap that been one of our been within our, I think, early clients batch, and also definitely the first client we had in Australia. So we've been tracking the Australia market and the APAC market for already quite some time. First and foremost, I think that the APAC market in general is one of the most active, or the interesting thing about the crypto market is that it's very global, right? So if you really want to service the crypto market, you need to almost go global overnight, and definitely it's 24/7 market. You need to be integrated. You need to have partnerships across the board and across the ocean. And I think that the Australian market, we've seen in the last couple of years, we've seen a big progress both from infrastructure providers such as Zero Cap that provides array of services from custody to execution, to other players that we partner with and are using our service that are more in the hedge fund, that are more in the asset management business. So definitely the Australian market been active. I think that the recent proposed regulation in Australia is very healthy. I think that what we've seen in other jurisdictions is that when there is a regulatory clarity, assuming that it's that the clarity reasonably makes sense, from a technology and it's aligned with what people are trying to do, it really sort of unleashes the market, right? So just as a reference points, both Singapore, Switzerland, Germany, all those places where there was a clear regulation around how you should provision custody, what does it mean, and so on. It basically created it put in motion a pretty large set of traditional clients that felt much more comfortable in terms of setting up those services and starting to properly service the market, and not only to focus on the crypto assets, but also starting to re-platform the traditional financial system from stable coins, from tokenized securities, and the discussion became way more interesting.
Yeah, fantastic. And you mentioned the regulation there, and the signpost that was given yesterday as part of Australian Blockchain Week by the Minister around the industry consultation. I think one of the things considered in that regulation is a licensing regime. The other a couple of other key points for there were around onshore custody. I'm wondering whether you might be able to comment around whether you've seen other jurisdictions, particularly with that onshore requirement around digital assets, and just what does that mean when it comes to a digital asset, and are there any misnomers which are unique about these assets as distinct from a gold bar, which physically sits somewhere versus a distributed computing network?
Yeah, so we've seen those kind of requirements in other jurisdictions as well. Sometimes in a more specific way, sometimes in a less specific way. For example, a similar concept exists in the German regulation, also in the Swiss regulation, whether it's explicit or this is the way it's understood and required. But eventually, the way that people, the way that usually, from a technical standpoint, right, understood is that part of the key management has to reside within an Australian control, right? So you basically need an onshore control of the private key and onshore control of or part of the private key, which basically guarantees that if you would be cut right from an international internet connection, then you can still basically recover the private key locally, and you can still continue to operate, and you are effectively not exposed to a third country or to an outside jurisdiction that can basically seize or suspend your private key, right? This is how we've seen in other areas. For us, in terms of how we provision, how we provide our client the access, this is actually sort of wired into the technology, right? It's direct custody model, so the client has the flexibility and the ability to provision it in the service in the servers of choice. So I think I think it makes a lot of sense. So.
Yep. Thanks for clarifying. I think sometimes there is a misnomer between the tokens, which exist, of course, globally across the network, but indeed, as you've called out, it's really then we're talking about the private keys. Now, Michael, I did want to talk a bit about the future, because I think the future is very exciting in this space, and wanted to get your views around, just in the last 2 minutes we have remaining, around how custody is going to change for the future. I mean, we see booming demand for DeFi. We see different asset types, such as NFTs, real-world tethered assets. How do you see the custody business changing as the type of asset that gets digitized changes?
Yeah, I mean, I think that the on-chain functionality of the custody is going to dominate more and more, right? So your ability to both do a much more on-chain services that are required, right, for interacting with DeFi. So, for us, DeFi, and when I say DeFi, I basically put in that bucket all the interaction with smart contracts. It can be DeFi, it can be stable coins, it can be a lot of other things. I also basically put also NFTs in that bucket. I think that what's really unique about NFTs, by the way, which we are now doing a very substantial work across the board, from fintechs to traditional folks, through, interesting enough, even corporate treasuries around it, is that NFTs really require almost this kind of unique addresses and the ability to not only be hot or interact with the blockchain, but also, if you are a service provider, if you're a bank or a fintech, you need to be able to almost like, provision, you have to provision every individual wallet for every user that you have, because eventually when people own NFTs, they want to represent that ownership on chain. So as a simple example, if you want your Twitter profile to represent the NFTs that you own, it has to sit under a segregated address, which means that if you have several hundreds or several million, hundreds of thousands or several million users, you need a scalable functionality to provision unique wallets for all of them, and clearly allow them to interact on chain and connect to OpenSea or to their Twitter account or whatnot. So it becomes much more interactive. Also applies to real world assets, also applies to tokenized securities. So this is the direction of travel.
Great, thank you, Michael. I feel like it's a fascinating space we could have talked about for another half an hour, but thank you for sharing your views on custody as part of Australian Blockchain Week, and congratulations on all the great work Fireblocks is doing in this space.
Scott, thanks so much for having us.